We all want some level of safety and security. Firefighters, construction workers, EMT. They're all there when you need them to help manage life's chaos. In retirement, you want that same level of safety, but who is there for you to make sure your money will last? Brian isn't just there in case of emergency. He's there so you don't have an emergency with your money. A safer retirement doesn't mean a boring retirement, but a prepared one, full of the things that inspire you. This is Safer Retirement Radio with Brian J. Decker.
Welcome to Safer Retirement Radio with Brian J. Decker and Arrin Wray of Decker Retirement Planning. I'm Mark Ellie. Glad you're with us today. You can always go to the website to learn more about Brian, Arrin, and the team. It is deckerretirementplanning.com. And I always give you this at the top of the show, the opportunity to go to that website, deckerretirementplanning.com, under the heading of Safer Retirement Education. There are like 12 different things you can download, including a retirement checklist, sample income plan, a 3 Principles of Retirement book, and Brian's book, The Decker Approach. That's just 4 of the 12 things you can download, and it's all there for your information. There's no cost, no obligation, no nothing. It's just there for your information if you want to learn more about different areas of retirement. If you have questions, though, and you want to talk to the team, you want to figure out, hey, can we retire? I wonder if we're going to be okay if we retire. Will our money last? Just give them a call. There's no cost for that either. It is 833-707-3030. We'll give you that number throughout the program, 833-707-3030. All right, Brian, you guys got a lot to get to, a little market volatility kind of in our conversation today with you and Arrin.
Yes, we're going to talk about the most important thing of a retirement plan, Arrin, I think, is how to properly pull money from the plan. There's a right and a wrong way. Let's talk about the wrong way. Bankers and brokers use a pie chart. So mathematically, when you draw income from a fluctuating account, you compromise gains when markets go up. You accentuate losses when markets go down. There's a guy named William Bengen who created the 4% rule. And want to have you, Arrin, take us through 2000, 01, 02, 03, 04, 05, 06, 07, 08, and 09. How did the 4% rule do for people?
It's kind of a leading question, Brian. Not so good. And to maybe provide a little context around this, when we refer to that 4% rule, this is people saying, hey, as a method for what's called the distribution in your retirement, meaning how do you decide when and how much to pull money out of the portfolio to actually spend, the 4% rule is kind of a generally known approach where they say, hey, if you got $1 million in your portfolio, you can pull 4% of that, so $40,000. And that is supposed to be a safe withdrawal amount that will allow you to take some money out and spend, but also not run out of money before you die. So what we're going to highlight for our listeners today is some of the problems with doing that, where it really is kind of like flipping a coin and just hoping for an uptrend in the market. So Brian, to your point there of early 2000s, terrible time for both the market and for those retirees that were using that 4% withdrawal approach. Because if you have a pie chart approach where you got either mostly equities or a mix of stocks and bonds, maybe you have a 70-30 or a 60-40 portfolio, and you're also pulling out 4% per year to live off of as income, early 2000s was not a good time period for you. So S&P 500 returns in 2000 were down about 9%. 01 was almost 12. 02 was almost 22, meaning that in a 3-year period, just from market losses, you're down about 40%. If you're also taking that 4% withdrawal approach, that's an extra 4, 8, 12% down over that 3-year period, meaning you have lost over half of your retirement portfolio in just a 3-year time span, had you been one of the unlucky people that retired in 99 or 2000. So you did get some recovery from 2003 through 2007, but then as you all know, 2008, 09 hit, we had another 40% drop in the S&P 500. And at that point in time, a lot of people had to make some not so fun financial decisions, selling their house, going back to work, moving in with their kids, all of those things that none of us want to do after we have retired and are supposed to be in those golden years. So that 4% withdrawal approach is not a safe way to be able to pull income out of your portfolio for retirement income because of the volatility of the market. And obviously, if you've looked at the market this year, especially the last few weeks, it's not done so well at this point in time either. And so we want to kind of walk you through a better way to do distributions out of your retirement portfolio that isn't just a flat like 4% or a 5% withdrawal per year. So, Brian, what would you add to that?
I just want to add that in defense of the bankers and brokers 4% distribution rule, the math went like this. Stocks have averaged around 8 or 9% for the last 100 years. Bonds have averaged around 4.5%. So let's draw 4% from our portfolio, and that should be fine. And it works in a classic up market. The problem is it doesn't work in a down market or a flat market cycle. And since in the last 100 years, there's been 4 times where the S&P 500 has traded above a market valuation of 30 times trailing earnings. And each time it's done that, we've gone into a flat market cycle. So 1929, and markets were flat for 17 years. 1964, markets were flat for 18 years. 1999, markets were flat for 14 years. In November of 2021, we hit 32 times trailing earnings. So with 100 years of history backing it up, we're looking at the next 10 to 15 years of flat markets. Now you think about that. For someone who's retired and counting on portfolio gains to finance your golden years in retirement, that's devastating. So I hope that your plan has an answer for that. Ours does. Arrin, we talked about this last week. We talked about how to make money in a flat market cycle. We're not going to spend time on that, but if someone wants to look at the previous radio show, talk about momentum risk strategies, able to make money in up markets and able to make money in down markets, that's how we handle the equity side. Let's stay high level still. I want to say one more thing about the 4% rule. William Bengen, who created it, said that it does work, and he created that in the mid-90s. But then when he saw what happened to millions of people who had their retirement destroyed by the 4% rule in 2000, 01, 02 through 2008, he came out in 09, and 09, proof that it doesn't work were the millions of gray-haired people who showed up at fast food, banks, real estate agents. They had to go back to work because they were running out of money. And William Bengen came out in 2009 and said that it doesn't work in a flat market. And yet the bankers and brokers still use that today. We want to warn people who are listening that if you're drawing money from a fluctuating account, you compromise gains when markets go up, you accentuate losses when markets go down. And we're warning you, it does not work in a flat market that's flat for 10 to 15 years. We expect that we've just entered that. Let's go on then and talk more in distribution, how the right way to do it is when you draw income from laddered principal guaranteed accounts. Mark, how much could you lose in a year, classic litmus test year like 2022? The S&P was down 19%, NASDAQ down 33%, bonds down 20%, commodities across the board were down. That's the year that Russia had invaded Ukraine. How much did our buckets 1, 2, 3, 4, 5, our laddered principal guaranteed accounts, how much did they lose?
Nothing.
Yep. Yeah, they didn't lose anything. That's one of the basic principles that we abide by here is making sure that in whatever circumstance you end up retiring in, right? Whether market's in just a tear, huge uptick, things are going really, really well, everybody's happy, or in an extremely volatile time period like we're in now, like happened in 2022, or big downswings, we want to make sure that our clients are protected in either circumstance. So with those principal guaranteed accounts, we didn't lose any money on those in 2022. And not only does that help from a mathematical standpoint from, hey, we have the protection there, we didn't lose money on those accounts, it also is extremely helpful from a peace of mind or a comfort standpoint. At Decker Retirement Planning here, we're very well aware that what we do is very much a pairing between the math, the finance, the numbers, and in the peace of mind, comfort, confidence that we provide to the clients that we work with. That when you have those different protection vehicles in place, and the market ends up in time periods like we're in now or in 2022 or will happen again in the future, you can know that you are not taking a massive hit on your entire portfolio. You have the protection in place to be able to weather those storms.
Okay, and what about rate of return? Let's talk about the importance of not losing money, but what about the different buckets? So, bucket one is a cash account. What kind of good return would a cash account provide? I know a lot of the banks are at 1%. What are we getting on our bucket one cash account?
Yeah, right now it's a little bit over 4%.
Okay, and then bucket two is a 3-year CD. How much are we getting there?
A little over 5. I think it's about 5.2 right now.
Okay. Bucket three is a 5-year CD. So how much are we getting with that one?
Just slightly above the 3-year, we're about 5.5.
Okay. And then we have a 7 and 10-year principal guaranteed account. Those aren't fixed rates, but those are averaging around 8 or 9%. So we're not giving up return by using laddered principal guaranteed accounts. But the important thing is to make sure that they are laddered to provide liquidity. So our bucket 4 and our 5 and our 7 and 10-year laddered principal guaranteed accounts, they're able to provide income up to 10% per year, no penalty. And so we're able to have the principal guarantee, we're able to get a good rate, and we're able to have up to 10% per year. We're able to pull money from it while it continues to grow. You can't do that with CDs. So it's important not to put a square peg in a round hole. We want to make sure that the pieces in your portfolio fit and do the job that they were designed to do. Let's talk about, Arrin, how do you make sure that you can avoid selling in a down market? How do you make sure that you're not going to take huge losses and lock that in by selling and providing income in a down market?
Yeah, this is a great question, because it's one of the principal faults of people that invest, right? Where they get into this arena, they get invested, things are going well for a while, they start to see the money gains in their account, and then all of a sudden things go the opposite direction, right? We have either a swift or a steady downturn. People start to panic. They think things are going to get worse from here, and they sell at one of the worst possible times. And usually what ends up happening at that point in time is they wait for the market to start to recover. So they want to see things turn around before they get back in. So they sell down near the bottom, and then they wait till things look rosy again. And then they jump back in and have missed the majority of the growth that they could have had from the market recovery. And so there's so many different charts and statistics and illustrations that we could look at that show that people that try to jump in and out based off just emotion and feeling greatly underperform the returns that you're going to get in other arenas if you have more of a disciplined approach. The second thing is specific to our financial plans, the income distribution plans that we build. You want to make sure that your money is allocated where it should be from a fundamental standpoint. And this is one of the very stark differences between how we approach our planning here at Decker Retirement Planning versus how a traditional financial advisor would allocate your funds, where most advisors are going to have some kind of a big pot approach, meaning they view your money as like one big pot of money, and they may tailor individual parts of that to have more or less risk based off of the risk tolerance questionnaire that they provide to you. In contrast, the financial plans that we build assign each bucket of money to have a specific purpose. So we've talked about the principal guaranteed accounts, the buckets 1 through 5. Their job is to provide protection for the funds, be used as the income source, and provide moderate rates of return. The risk account is fundamentally different. It is not intended to protect the funds, and it is not intended to be used as an income source. Its job is on high growth over a longer time period. So when we help allocate the funds between those principal guaranteed accounts and what is at risk, it's built with the intent that you can weather the storms that will come about. We all know there is going to be market volatility at some point in time in the future. It is just a fact of investing that it's going to be there. And so we want to make sure that we, from the ground up, build your plan so that when it does happen, you aren't in some sticky situation where all of a sudden you now have to pull out a whole bunch of money for either some emergency or for regular income or for some other reason that, to your point, Brian, exacerbates the losses on the way down, right? So when there are market drops like we have right now, like we had in 2022, 2008, because the clients that we support are not withdrawing funds directly from those risk accounts, those volatile accounts, they don't have to worry about the market drops there because they don't need that money in the near term. We plan for that volatility. We know there's going to be ups and downs. And so we make sure that we're not touching that portion of the portfolio that's at risk, especially during time periods when the market's in a volatile downtrend. And so it gives us the ability to really help you both financially and mentally, that you don't need to touch that money. You don't need to be fearful when there are market drops because we've already planned ahead for it and we've invested the money in such a manner that's going to insulate you from those things.
So does that sound like a plan that you have? Is that your income plan for your retirement? Or is it all coming from your market monies? What is your plan? Where is your income coming from? If you'd like to sit down with Brian and Arrin and the team at Decker Retirement Planning, just give them a call. There's no cost, 833-707-3030. Again, there's no cost for this. There's no obligation. There's no pressure. 833-707-3030. Might be the most important phone call you make. Certainly today, 833-707-3030. Just getting started on Safer Retirement Radio with Brian J. Decker and Arrin Wray of Decker Retirement Planning. Back with more right after this.
Tax laws change, but smart planning stands the test of time. Don't leave money on the table. Let Brian Decker and the team at Decker Retirement Planning help you maximize your tax strategy. Call 833-707-3030 today.
Uncle Sam might need a loan soon from you. We have over $36 trillion in national debt. Where do you think the money to pay for that is going to come from? Taxes. Believe it or not, taxes are at historic lows right now. But how much longer will that last? A Roth IRA conversion might be a good option when planning for your retirement because you can pay lower taxes now and avoid potentially higher taxes later on. Brian Decker and the team at Decker Retirement Planning have seen taxes rise and fall. They know what options you have to potentially reduce the amount of taxes you pay in retirement. Call the team at Decker Retirement Planning and schedule your tax analysis today. 833-707-3030. That's 833-707-3030. Uncle Sam needs money. Don't let him take it from you. 833-707-3030. Investment advisory and insurance services offered through Decker Retirement Planning, Inc., a registered investment advisor. Investing involves risk. Always consult with a qualified tax advisor before making any decisions regarding a Roth IRA conversion, as there may be additional tax considerations.
You're listening to Safer Retirement Radio. If you like what you hear on today's show or have questions, drop by DeckerRetirementPlanning.com or call 833-707-3030 to talk to Brian.
Welcome back to Safer Retirement Radio with Brian J. Decker and Arrin Wray of Decker Retirement Planning. I'm Mark Elliott. We're talking about how do you make sure that you have income regardless of what's going on in the markets when you get into retirement. Now, here's one thing that Brian and the team at Decker Retirement do usually a couple times a month, and that is they have dinner seminars. No charge to attend. You just have to sign up. You have to RSVP. Yes, I would like to attend that seminar on that topic on that night. That's your opportunity. So if you're in Seattle or Salt Lake areas, all you have to do is call them, say, hey, what's going on? Or you can go to the website, DeckerRetirementPlanning.com, find out about events there, sign up right there as well, or just give them a call. Say, hey, I'd really like to attend your upcoming seminar on taxes, on volatility in the market, on whatever the topic is, and you want to learn more, just call them. 833-707-3030, 833-707-3030. And I think you can always find the events on the DeckerRetirementPlanning.com website as well. All right, Brian, you and Arrin still got a lot to cover. We're just underway. Where are you headed now?
Emotional side of drawing income from a fluctuating account. When markets are up and your portfolio is up, oh no, Arrin, I don't want to sell because I'm making a lot of money. And then when the markets are down, oh no, Arrin, I don't want to sell. I don't want to lock in these losses. So unless you have protocol, unless you have a rules-based plan, it's my experience, Arrin, that people are just really horrible at knowing how to properly draw income out of these accounts. When you've got principal guaranteed accounts. Take us into the details of the construction. And by the way, we're fiduciaries to our clients. We're a math-based firm. We do the homework. We have a 6-figure research budget, and we go into the databases to find the highest earning principal guaranteed account offerings from banks and insurance companies. And we do the same thing on a quarterly basis with the databases used to track the best returns that we can find for the risk strategies. But let's kick it back to the principal guaranteed accounts, buckets 1, 2, 3, 4, and 5. Give us the details on that.
Yeah, and I want to highlight a point that you touched on briefly is that you have to have a rules-based approach to your distribution planning, to your financial planning. If your quote unquote plan is to just wing it, to just go by feel, to just kind of stick things in and hope for the best, you're just setting yourself up for disaster, right? Like nobody has a gut feeling that's right every time on whether to buy, whether to sell, and when to do so. You're just setting yourself up for a lot of heartache, poor outcomes, and not a great retirement from a spending standpoint. So that's why we are rules-based. It's why we are math-based. When we put together financial plans for clients, it isn't just, hey, let's put $100,000 here, $200,000 here, and that probably looks good. We know exactly to the dollar how much to put in each of the categories: protected, at risk, emergency fund, when we're going to use those, what income that can provide. Everything is extremely fine-tuned to make sure that we have the best outcome for you. And so it makes it really easy when we are both walking through this stuff and through the actual use case or implementation phase, because we have the math, the rules, the logic to back up the decisions that we've helped you make when actually getting these solid financial plans put into place. So I just wanted to highlight that point, that and at 5 years down the road, when you may have questions about things or there's volatility going on or something, we can point to exactly the reasons why we made the decisions that we made. There's never going to be guesswork in this. It's never just let's hope for the best. We want to make sure that everything we can control, we do control. So circling back to your point on the principal guaranteed accounts, that is something that we take very seriously because there's a lot of money that goes into those accounts. It's typically the majority of the funds that people put into their income distribution plans. And again, this is where the protection in your plan comes from. So the way that we line this out is through typically 5 or 6 principal guaranteed accounts that all run for various lengths of time. So for example, we start with bucket 1. It is usually a 3-year duration account where we use it as part of the income that you're receiving in retirement for the first 3 years. Then the subsequent accounts, buckets 2, 3, 4, and 5, have longer durations, usually 5, 7, 10, and about 15 years, where the goal of this structure is to ladder out these principal guaranteed accounts to protect the funds, make sure that they're liquid when you need to pull them as income, and get the highest rate of return on funds that you don't need in the early years as income. So it kind of gives you the best of both worlds, where you both protect the funds and you have a higher rate of return on funds not needed yet for income. And we typically take these as income in a laddered fashion, where again, we'll use bucket 1 for that first source, draw it down over a 3-year period. We then shift over to using bucket 2 for the income source. After it's been depleted for the following 2 years, we shift to bucket 3, and then bucket 4 and 5, and so on. So it's a great way to have a rules-based approach, a math-based approach, provide you the protection that you need, give you that peace of mind that regardless of what the volatility is or what the market outcome is, you're going to have the income that you need. And this is one of the fundamental things I really like to walk people through, is that I think everybody inherently knows there's going to be volatility in the market over time. But what they don't know is how that volatility is going to translate to the amount of income that they're going to be able to spend every month. And so our goal at Decker is to prevent situations like, hey, market had a great year, you can probably spend a little bit more money, up your income a little bit. Or dang, market had a 30% drop this year, you should probably cut back on your spending for a couple of years to recover. We don't want your monthly or yearly income bouncing all over the place, depending upon whether the market had a good or a poor year. We want to give you good numbers that you can rely on, that you have a very good idea about what the income expectations are. And then with our conservative assumptions, we like to outperform that. So it's a goal of ours, again, to just give you the peace of mind, have the mathematics to back that up, and allow you to be able to go off, spend the money that you need to spend, and enjoy what you want to do with your time. So we want to make sure that you're not just glued to the screen, glued to the news. We want to take that burden off of your shoulders and make it as easy as possible for you to have that protection in place and feel comfortable moving into those retirement years.
A couple other things, Aaron. I've noticed that many times we're not getting the best CD rates from the banks. We're getting better rates using CDs from an insurance company. Same principal guaranteed, same fixed rate for 3 or 5 years. So I thought that was interesting. Aaron, there's 4 key reasons we draw from laddered principal guaranteed accounts. I think we'll jump on that in the next segment.
So that's where we're going next. But if you have questions about any or all of this, because really at the end of the day, retirement comes down to income. Where are you going to get the money to replace the paychecks that are no longer coming in because you're no longer working? Is it from your IRA and your 401ks? Well, there's some challenges with that. Tax is obviously one of those. Markets go down. That's not a great time to pull from that. So what are your other options? That's what Brian and Aaron are talking about today. How to create that income stream regardless of what's going on with the markets. How is your portfolio set up? And that's where Brian, Aaron, and the team at Decker Retirement are all about helping you figure that out. 833-707-3030, 833-707-3030. And we also have some more information for you if you'd like it. All you have to do is call that number, 833-707-3030, and say, hey, I would love to get that retirement toolkit that they were talking about on the radio show. There's 2 ebooks. There's also a sample plan on how the whole process works. So if you'd like the free Safer Retirement Toolkit, just call 833-707-3030 and say, hey, I'd love to get that toolkit. It comes with 2 ebooks and a sample plan. 833-707-3030. Brian and Aaron back with more of Safer Retirement Radio right after this.
Do you need help ensuring any remaining assets that you've worked so hard to create are distributed to your beneficiaries in the most tax-efficient manner? If you would like to talk or meet with Brian about your legacy planning, call 833-707-3030. Again, that's 833-707-3030.
When you crash your car, you get it fixed. When your computer crashes, you get a new one. But what will you do if you've been saving in a 401k or an IRA and the market crashes? If you're in your 30s or 40s, you'll likely be just fine. But if you're in or near retirement, you could be in trouble. Brian Decker and his team at Decker Retirement Planning are here to help. They can run a risk analysis to see if you're too heavily invested in the market. Are you confident that a Wall Street crash won't wreck your retirement? If not, call 833-707-3030 today to schedule your risk analysis with Brian Decker and the team at Decker Retirement Planning. That's 833-707-3030. Crashes happen. Question is your retirement ready? Decker Retirement Planning, 833-707-3030. Investing involves risk, including the potential loss of principal. Investment advisory and insurance services offered through Decker Retirement Planning, Inc., a registered investment advisor.
Glad you're with us today for Safer Retirement Radio with Brian J. Decker and Arrin Wray of Decker Retirement Planning. I'm Mark Kelly. Glad you are with us today. Again, you can always go to the website to learn more, deckerretirementplanning.com. You can sign up for dinner seminars there under the events tab. You want this free Safer Retirement Toolkit, you can ask for that as well. You can always call for that information as well, 833-707-3030. We're talking about income today. I'm Mark Kelly. Glad you're with us, but we're talking about income today. Brian and Aaron are talking about, when the markets get going the wrong direction, then if you're pulling money from your market funds, you're getting a double whammy, right? So you're kind of really depleting your savings to last as long as you need it to last for as long as you're here. So there are options. So that's where you're headed now, isn't it, Brian? The options where you're pulling from ladder protected, principal protected accounts.
Yeah, that's foundational to the planning that we do at Decker Retirement Planning. And there's 4 key reasons why we draw from them the way we do in our planning. One of them is peace of mind. So you can have all kinds of things happening, like in 2022 when the S&P was down 19, NASDAQ down 33, bonds were down 20, commodities were down, Russia had invaded Ukraine. There was a lot of things going on, and our clients lost nothing on their laddered principal guaranteed accounts. Very, very important is peace of mind is number 1. Number 2 is we're using compound interest to our advantage. We draw from the lowest earning accounts first, allowing the higher earning accounts to grow and compound as time goes on. So where you're getting the higher returns, we want that carrying the larger amounts of money for the longer period. Third thing, we use very conservative estimates for rate of return on the top or the headers of each bucket. So we have a 1% estimate on the top of bucket 1 when we're in fact getting 4.3 on that. We're using 3% on bucket 2 and we're getting 5 on that. We're using 4% on bucket 3 and we're getting 5.5 on that one. And then buckets 4 and 5, we're estimating at 4 and we're getting more than twice that. And then the risk bucket, we're showing 6 and we're averaging, since inception, the money managers are averaging 3 times that. So this is a place that we're being very, very conservative for 2 reasons. One, human nature, Arrin. People want to hear you're ahead of schedule, especially in retirement where you can't make up for any losses. You want to hear those words, you're ahead of schedule. And 2, you want to look at next year's income and see that you are going to have high confidence that you're going to be at least that and probably more. So we put the bar very, very low. The fourth and final way that we draw from laddered principal guaranteed accounts is in the 15 or 20 years that you draw through buckets 1, 2, 3, 4, and 5. It gives 15 to 20 years for the risk bucket to grow and compound more than offsetting what you've started with. And it gives a replenishment or an injection of capital into the next buckets 6, 7, and 8, to see you through from your mid 80s to the rest of your life. So Arrin, anything you'd add to that? Those are 4 key reasons that we draw from the laddered principal guaranteed accounts.
Yeah, I would just kind of expound upon a little bit there that most of the people, almost all of the people that we work with, haven't been retired before, right? This is a new situation for you. You've worked for the last 30 or 40 or 50 years, and now you're transitioning into the second phase of your financial life. And it can be pretty scary. It can be pretty anxiety inducing where it's new. You haven't had an opportunity to kind of practice in this arena before. A lot of people have had decades and decades of a paycheck coming in every couple of weeks. And now you're shifting into this era where you're going to actually be using and spending the money that you have worked so hard to accumulate. So that from like a mental shift, from a mindset shift standpoint, can be really difficult to kind of make that leap of faith of stopping work and actually going into retirement. And our entire goal here at Decker Retirement Planning is to make that as easy as possible, to take that burden off of your shoulders, to give you high confidence that the plan is structured the way that it should be, that you have the protection in place that you need to have so that you can go off and enjoy doing what you want to do with your time. Our clients don't want to have the conversation, and we don't want to have the conversation of, hey, we actually got to cut this by 50% because these things went awry, market didn't quite go in our favor. From a fundamental approach, from the ground up, we build our plans to prevent things of that exact nature. We don't want you being one of those articles that came out in 2008 of the financial disaster situation that you ended up in. So I just want to be really, really clear to our listeners and drive the point home that we take everything seriously from a protective standpoint. We want to keep you retired. Our slogan, our trademark is a safer retirement, and we take that very seriously. Ours is definitely not the shoot for the moon and hope to hit it approach. So again, where you have less room for error in retirement, less time to accomplish some of these things, we want to make sure that we put the proper structures into place to give you that success that you're looking for, that you've worked so hard to be able to get to from a retirement standpoint.
All right. So now let's get into the risk bucket. Anything else that you'd say? Oh, actually, there is 2 more things. One is when people come in and do planning with us, most of the time they are retired or they are within 5 years of retirement. So if they're already retired, 90+% of the time, Arrin, don't you agree that they're seeing higher income than what they expected in their planning?
Oh, absolutely. It's actually one of my favorite meetings when we get to show people their first version of their financial plan. Because exactly to your point, 95% of the time, they're like, oh my goodness, I didn't realize I could still spend that much. I actually had a client meeting this last week that was that exact situation. He had, in our first evaluation, kind of given me a hope as far as what the income that they were shooting for was. I said, okay, we'll run the numbers. We'll get back to you. We sat down for the second visit. I brought out his first income distribution plan, showed him what it looked like. And he went, oh my goodness, is this real? Like, he's like, this is almost too good to be true. And I could just see this smile on his face that just lit up my heart, where, again, we're not the shoot for the moon to hope to hit it approach. We have conservative assumptions across the board, and still we were able to exceed the level of income that he and his wife were hoping to have in retirement. And it's one of my favorite parts of the role that we have here, where we get to exceed the expectations while still putting a lot of protection measures in place that you are going to be okay. This is a consistent income. This is not the 1 in a million scenario. This is the base case. And I have client meetings like that all the time, where they just are so appreciative of the way that we approach this, the numbers we're able to show them. It's not some ethereal, just trust me and hope for the best. And we're able to exceed the level of income that they were originally hoping for.
All right. The other way is if they're within 5 years of retirement. And I'm glad we do the planning for those people, because most of them are very, very happy that they've done the planning, because they fall into one of two categories there. And category one is, wow, I might be able to retire sooner than I thought. The second category, and I'm very happy that we're catching these people too, they find out that they need to hit a certain income level. And if they can't, we can do the calculations to find out how long they need to work before they can retire.
Mm-hmm. Yeah, that's a great point, Brian, that it's knowledge to help you make an informed decision, right? Like, it's at least personally, I could never get to retirement, just have a pot of money and say, well, I think I'm going to retire. I think I'll have enough. I'll just start spending and hope I have enough to last me until I die. Like, we want to provide you more surety than just a hope for the best approach. And so, to your point, with the mathematical driven approach that we have, it gives us a lot of power to help you make informed decisions, right? Because I do have people all the time say, yeah, I think I don't know, based on my own calculations or from my other advisor, I think I'll be able to retire about this point in time. Then we go have our team run the plan, come back to them and say, actually, you could call your boss today and say, hey, I'm done. And sometimes they do that, sometimes they don't, but it gives them the freedom and the knowledge to make an informed decision. And then same thing on the other side, right? We would hate to have a client or a person retire, have a specific level of income that they needed to hit for their needs, and then not be able to have that. And 5 or 10 years down the road, then realize that there's a problem, right? If there's a problem, if there's things that need to be fixed, if you need to make tweaks and adjustments to get you to where you want to be, you would probably rather know that now than after you've already taken some steps to retire, move into a different financial situation. And so for us, the goal is to give you that information from a mathematical standpoint to make an informed decision. And that's one of the main things that we do is translate all of the hard work that you've put into getting to where you are, the years and decades that you've worked and saved and invested to get to the point that you're at. We want to take that and translate that lump sum, that pot of money into, okay, here's what you can actually do with this. Here's the income that you can have. Here's the protection that you can have. Here's the amount that you're going to be able to pass as legacy if that's a priority. We want to basically take that accumulation mentality, that asset or building up that nest egg mentality, and translating that into, okay, now what can you actually do with this from a use case standpoint? And so that's my favorite part, is helping people see that even though they've done a great job building up these assets, we want to make sure we can translate that into how you're actually able to use them. So from a plan standpoint, it's when can you retire? What type of investments do you need to put into place to hit those specific goals? And then on the opposite side, like I mentioned a second ago, we do have people that don't want to spend all of their money. And that's great. They may have use cases for giving while they're alive, inheritance after they pass away, charitable contributions, whatever it may be. And again, with our math-based approach, we can help you both diversify the investments and help you allocate them to the proper place based off the goals or the use case that you have assigned to that money that you've worked hard to build up. So, Brian, anything you'd add to that?
Let's move on and go into the different types of risk strategies that are out there. And I think we have time to hit the main ones. I want to start first and you follow up with indexing. So I'm going to do the Warren Buffett buy and hold of good quality companies. I'm going to rattle off to make a point of creative destruction, how the portfolio of 40 years ago, if you buy good quality companies and hold on for decades, you have two risks in retirement. One is creative destruction. So there's some great companies out there, Aaron, such as Eastman Kodak and Polaroid and Kmart. And those companies I just mentioned are no longer around. Blockbuster Video, Mark's favorite. Those companies aren't around anymore because other companies, like, for example, what got rid of Eastman Kodak and Polaroid? The cell phone. What got rid of the baby bells? Mountain Bell and Pacific Bell. The cell phone got rid of those too. And so when you have some new technology that comes along and destroys whole industries, that's called creative destruction. So you've got to be very careful when you watch a company go from a very valuable, good growth stock to where it is ticking down to zero, and it eventually goes to zero because it's been replaced. So that's one risk. It's called creative destruction of buying and holding good quality stocks for decades. The second is no downside protection. So we talked at the start of the radio show about how the next 10 to 15 years, if history repeats, we're looking at another 10 to 15 years where the stock market takes 2 steps forward, 2 steps back, and has a net zero gain over the next 10 to 15 years. That means all passive buy and hold investment strategies will yield a zero return. Buying and holding stocks, indexes, ETFs, mutual funds, those will yield a zero return if the next 10 to 15 years are like other flat market cycles. Anything you'd add to that, Aaron, before you take us through the indexing advantages, disadvantages?
No, I think those are great points. It's one of those things that you just have to remember, and we have to remind clients of this all the time because it is new, that you are not in the accumulation phase of your financial life anymore. When you're 30, 40 years old, you have a lot more freedom, a lot more leeway to do some of those types of investment strategies because, number one, you have a long time horizon, and number two, you're adding to those retirement accounts, not withdrawing income. But in retirement, both of those things change. Time horizon is much shorter, and you're actually withdrawing money to spend versus adding to your 401ks or IRAs or whatever other retirement accounts. And so it's one of those things where we have to help clients see that you're in a fundamentally different phase of life, different financial situation, and that also warrants a change or an adjustment from an investment strategy standpoint. So from an indexing standpoint, speaking of indexes like the S&P 500, the Dow Jones, the NASDAQ, those are great ways to be able to invest during the accumulation phase of your financial life because, again, long time horizon and you don't need to touch the money.
All right, so I'm going to cut off Aaron right there. We're going to get into the indexing part that he was just starting with because we need to wrap this segment up. We're going to come back and talk more about that. Again, 833-707-3030 if you'd like to learn how all of this pertains to you and your situation, which is really what it's all about. That's why Brian and Aaron do this radio show every week. It's about you. How can they help you, give you some things to think about, and then you go, I don't think I have that kind of a setup. I better talk with the team at Decker Retirement. Well, there you go, 833-707-3030. No cost, no obligation, no pressure. 833-707-3030. Back with our final segment of today's Safer Retirement Radio with Brian J. Decker and Arrin Wray of Decker Retirement Planning right after this.
Economic uncertainty is inevitable, but with the right plan, your finances don't have to suffer. Get the latest market insights and strategies from Brian Decker and the team at Decker Retirement Planning. Call 833-707-3030 to stay informed.
When you crash your car, you get it fixed. When your computer crashes, you get a new one. But what will you do if you've been saving in a 401k or an IRA and the market crashes? If you're in your 30s or 40s, you'll likely be just fine. But if you're in or near retirement, you could be in trouble. Brian Decker and his team at Decker Retirement Planning are here to help. They can run a risk analysis to see if you're too heavily invested in the market. Are you confident that a Wall Street crash won't wreck your retirement? If not, call 833-707-3030 today to schedule your risk analysis with Brian Decker and the team at Decker Retirement Planning. That's 833-707-3030. Crashes happen. Question is your retirement ready? Decker Retirement Planning, 833-707-3030. Investing involves risk, including the potential loss of principal. Investment advisory and insurance services offered through Decker Retirement Planning, Inc., a registered investment advisor.
You're listening to Safer Retirement Radio. If you like what you hear on today's show or have questions, drop by DeckerRetirementPlanning.com or call 833-707-3030 to talk to Brian.
Glad you're with us today for Safer Retirement Radio with Brian J. Decker and Arrin Wray of Decker Retirement Planning. I'm Mark Elliott. Again, the website, DeckerRetirementPlanning.com. There is a heading there when you go to the website of Safer Retirement Education. Under that, there's also live events. So you could sign up for one of the dinner seminars right there, whether you're in Seattle or the Salt Lake area. All that information is right there on the website, DeckerRetirementPlanning.com, under the Safer Retirement Education, and live events pop up. You can also go there if you'd like to download or grab any of the 12 different things that are there for you to download, including Brian's book on retirement, The Decker Approach. So that's DeckerRetirementPlanning.com under the heading of Safer Retirement Education, live events, and the 12 different things you can download. So a lot of information right there on the website. You can always call them, 833-707-3030. All right, at the end of the last segment, Arrin, I interrupted you as you were getting into the indexing world. I know you're also going to get into dividends in this segment as well, right?
Mm-hmm. Yep. So we were talking about different what are called risk-oriented strategies, meaning the focus on high growth for that investment. And indexing is one of the most common approaches for that. So most people have heard of the S&P 500, the Dow Jones, the NASDAQ, the Russell 2000s. There's a number of different indexes, but the goal with index investing is to put the money into the account, let it sit there for a long duration. You ride the volatility up and down, and you get the long-term average returns of that specific index. So there are some advantages to index investing. One is performance. You own the index that beats about 85% of active money managers and mutual funds each year. The second advantage there is diversification. So for example, if you're thinking about the S&P 500, it's 500 plus of the best companies in the world. You're not just putting all of your eggs into one specific company, hoping for the best. And one of the third reasons is cost. Expense ratios on those types of ETFs are very, very low. There's a number of different brokerage firms that have them. For example, you have SPY or some of those others that the expense ratios are super, super low. So the main reason why we would recommend not doing this for the majority of your portfolio in retirement is that there isn't any downside protection. So again, markets are going to be volatile. There's going to be ups and downs over time. We've talked about flat market cycles where you can go a 10 or a 15-year period where indexing doesn't give you any positive growth. So if you're in retirement, say you're 65, you're 75 years old, and you go a 10 or 15-year period with zero growth on that portion of your portfolio, how is that going to work for the rest of your plan? Are you going to have enough income? Are you going to have the money that you need to do the things that you want to do? It tends to make it a lot more difficult when you have a chunk of your portfolio, especially if it's the majority, if you've got some type of a pie chart allocation and you don't make any money over the course of that 10, 15, 18-year period. So again, best for the accumulation phase, not great for the majority of your portfolio in your retirement years.
All right. Well, now, probably one of the most popular risk strategies out there is this last one we're going to talk about, which is the dividend strategy. This is where you buy good stocks, good quality companies that pay a dividend. Right now, the 10-year treasury is yielding around 4.2%. So that's called the riskless rate of return. The 10-year treasury yield is usually the riskless rate of return, 4.2%. So Arrin, one problem that we see with the dividend strategy, it's human nature. It's called yield creep. After a year or so of putting these together, if you can find a 5%, 5 is better than 4.2, right?
Yep, absolutely.
And if you find a 6% dividend yield, that's better than 5, right? So in 18 months or so, you immediately have a lot of your investment that you think is in low risk shifted to 7, 8, 9% dividend yields, and that's high risk. That's twice the yield of the 10-year treasury. You think it's low risk when it really isn't. And the way we know that is the second point, and that's looking at coverage, dividend coverage. So we're a math-based firm. We do the research and we find out, we look at XYZ company that pays a 9% dividend yield, and we find out that lo and behold, it pays $1 dividend, but the EBITDA, earnings before interest, dividend, taxes, and amortization, come to find out that that's at 60 cents. So to pay $1 dividend, they have to borrow to pay the dividend. How long is that going to happen? Probably not very long. So that's something that is high risk when you have less than 1.0. Actually, for us, it's 2.0. It's got to have 2x coverage for the company's cash flow to pay the dividend for us to say that that would be a low risk investment. But many people have no idea what I'm talking about. And it's just a matter of making sure that the dividend that you're getting is safe and covered by company cash flow 2x. But the biggest problem is called concentration. The biggest problem is that the majority of all of these dividend stocks, Arrin, lie into two sectors of the economy. One is energy, the other is real estate. Does energy cycle? Absolutely. In 2020, that was the only year in my lifetime in this business, 40 years, that I've seen an energy contract or any agricultural or commodities contract go negative. In 2020, we saw the August crude oil contract go negative. And in 2020, that was also a year when dividends on the energy sector, they were canceled and deleted like flowers in the springtime. And then how about real estate? Does real estate cycle? Well, in 2008, the average REIT was down 70%, 70. And that was the year that a lot of dividends were canceled or cut back. So yeah, you can't afford in retirement to have a dividend cut, because what happens is after the close, they announce the dividend cut, and then you hold it in your portfolio because it pays a 7, 8, or 9% dividend. Well, now it pays no dividend and the stock opens up down 25%. You have to sell it because it no longer pays a dividend. So you realize that loss. That is how a dividend cut works. So we want to warn people that in retirement, concentration risk, dividend yield coverage risk, and yield creep are three problems that go along with that strategy. Arrin, what else would you share?
No, I would just kind of highlight a couple points there that a lot of people will take some kind of an approach where they just say, hey, I'm just going to buy a whole bunch of dividend stocks in my portfolio and that's going to be my income, right? They say, hey, if I don't touch the principal that I invested and I just live off of the dividends that this kicks off, I'm going to be okay. Now, that can work in theory, right? Like from a principal standpoint, it sounds okay. But to your point, Brian, there are risks, especially if you get into some of those higher yielding securities. If you have to take a big principal loss on that, reevaluate the portfolio, buy some other stock. Now, not only have you taken a asset reduction, so your asset base is lower, you are now also earning a lower dividend dollar amount that you could use as income. So again, where our fundamental principles are to supply confidence and consistency in the income level that you're receiving, having the majority or all of your funds in some type of a dividend portfolio does not achieve that. It doesn't give you consistency over time, and it is not principal guaranteed. So again, there's a lot of different ways to invest in retirement. You need to make sure that the goals that you have for the money line up with the implementation method that you've chosen. So that's, again, where our expertise lies, where we work with people in retirement. We've done this for years and years and years. We've seen some of these horror situations play out. And so we want to warn all of the people that we work with about the risks of the choices that they're making. Again, we want to make sure that you have all of the information. We're trying to help you to make an educated decision to get to where you want to be. That's one of my favorite things about being an independent retirement firm, is that we don't have one specific way that we do it for everybody. We don't have this one box of things that's the only investment strategies or investment vehicles that we can touch. We have the ability to do our own research, find the best performing vehicles, the best strategies, the best methodologies, and then deploy those things for the specific people that those work well for. So again, we will make sure that anybody that we meet with, we're talking through your goals, your use cases, how you want the money to be utilized, and we'll give you the best way to be able to get there. That's why we're warning you about those things, to make sure that you end up in the place that you want to be.
833-707-3030 is the number to chat with Brian, Arrin, and the team at Decker Retirement about any of this. 707-3030. Again, no cost for this. And again, on the website, deckerretirementplanning.com, where you can download all that information, Brian's book on retirement, The Decker Approach. You can also, on that same part of it, deckerretirementplanning.com, heading of Safer Retirement Education, you can find out about the live events. They're right there as well. You can sign up right there as well. 833-707-3030. Brian and Arrin, thanks for your time. Enjoy the rest of the weekend. We'll do it again next week.
Thanks, Mark.
Thanks, Mark.
Security and insurance services offered by Decker Retirement Planning, a registered investment advisor with the SEC. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This radio show is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual situation. Decker Retirement Planning is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein, provided by third parties, have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by Decker Retirement Planning. This radio show is a paid placement.